Fair value gaps can be a powerful addition to your trading strategy, but if you're planning to utilize them, it's essential to know what defines a valid and actionable fair value gap. That's why we've simplified everything you need to know for effective FVG trading into 7 straightforward tips. So, if you're into mastering advanced trading principles, understanding entry setups, and staying consistent with a trading strategy, make sure to hit that like button and subscribe to the channel. We share tons of deep trading content. See you right after the intro. But first, it's important to understand how they function. In this example, we see a sequence of 3 bullish candles, and within this formation, a bullish fair value gap is present. The gap appears when there's a void between the upper wick of the first candle and the lower wick of the third candle, commonly referred to as a bullish imbalance. Here's a straightforward explanation of why these imbalances matter. The chart prefers balanced price action, and to maintain this, it needs participation from both buyers and sellers during movements. So, when a move occurs with only buyers involved, it results in a bullish imbalance. Likewise, when just sellers are participating, it leads to a bearish imbalance. Following this logic, this zone represents a bullish imbalance due to the strong impulsive move driven by buyers, suggesting that in the future, price is likely to be attracted back to this area before resuming its upward trend. Once this happens, the area is considered rebalanced. We also have the bearish counterpart, which operates on the same principles. The key difference is that the imbalance occurs to the downside, meaning we anticipate price to move up into the zone from below to rebalance it before continuing the next downward leg. If there is no gap between the first and third candle's wicks, like in the formation on the right, it means the price action is already balanced, meaning there is no fair value gap to trade. So now that we've covered what fair value gaps are, let's start off with our first tip, which is that you should only use FVGs that align with the current order flow. Price can only move in 2 directions, but it rarely moves in a straight line. Instead, it creates many smaller moves that together form the larger swings. In the case of an uptrend, we know it remains valid only if it keeps making new higher highs. After a high is created, a retracement is expected. When price pulls back, it needs to find support to launch the next leg up, and this is where we look within the previous leg to identify a bullish fair value gap, FVG, that can provide the liquidity needed to fuel that upward move. We can see a great example on this chart. Every time a higher high is formed, we then see a retracement into a bullish FVG, where price finds the support it needs to continue the upward push. As for downtrends, we know that in order for the price to continue creating new lower lows, it needs to find a form of resistance to create the next leg down, and this is when we would use a bearish fair value gap. We can see an example of this here. Within this downtrend structure, every time a new lower low formed, it then retraced back up and into a bearish fair value gap, where it then saw resistance before continuing the move down. So to sum this up, during an uptrend, we only use the bullish fair value gaps that form, and during a downtrend, we only use the bearish fair value gaps. This makes sure we are correctly following the order flow of the chart. Now moving on, the next tip is that you should never use an FVG that has already been touched. For example, here we have a fair value gap, but if we look closely, we can see that the price has already dipped into it. Even though it barely entered the FVG, we still consider it mitigated, meaning it has become greatly weakened. And if we are looking for the highest quality fair value gaps, we may no longer want to consider using this one. But with that said, it doesn't mean this FVG will definitely fail if the price moves back into it for a second time. It's just a warning that FVGs that have already been touched should be considered weaker than those that haven't been. For our next tip, you should be targeting fair value gaps that are created within a discounted area. To give an example of this, here we have a strong bullish move. But when we mark out the fair value gaps, we have a few to choose from. So the question is, which one should we be targeting for our trades? Well, the first thing we should do is mark out the top and bottom of the move, along with the 50% mid-level. This will give us what we call the premium and discount areas of the range. To put it into simple terms, if we are looking for long trade setups, the ones found within the discount area will always be the strongest. So when we now look back at the chart, these highlighted fair value gaps are the ones we should be targeting for our long trades. And we can do the same for bearish FVGs within a downtrend. The only difference is we want to be targeting the fair value gaps that were created in the premium area, which is anywhere above the 50% line. Now we are moving on to some of the more advanced aspects, starting with our next tip. Now we're moving into some of the more advanced concepts, starting with a powerful tip, combining fair value gaps, FVGs, across multiple timeframes for more precise entries. Most traders who use FVGs tend to enter trades from either the top, bottom, or middle of the gap. While this isn't necessarily incorrect, there's a far more strategic approach that can tighten your entries and improve trade precision. Let's break it down with an example. Suppose we identify a bullish FVG on the 4-hour time frame. The gap provides a potential reversal zone, but it's quite broad, leaving us with a wide margin of error. Instead of blindly entering anywhere within this range, we can drop to a lower time frame, like the 15-minute chart, to get more clarity. On this lower time frame, we analyze the internal structure of the 4H FVG. When we do that, we often find a smaller, refined FVG, in this case, a 15-minute fair value gap, that formed within the same price zone. This creates a confluence zone, a 15-minute FVG inside a 4-hour FVG, significantly increasing the probability of price reacting from this area. This multi-timeframe alignment provides a tighter stop loss and higher confidence in your long entry, making it a key strategy in smart money trading. The next key tip is to recognize that the third candle in a fair value gap, FVG, formation is the most critical. Let's say we observe two strong, impulsive bullish candles. At this point, even before the third candle opens, we can already estimate the maximum potential size of the FVG. However, our main focus isn't the size of the gap, it's how the third candle forms that truly matters. For instance, if the third candle turns out to be bearish, we classify this as a rejection FVG. These setups should generally be avoided. Why? Because the formation of a bearish third candle signals strong seller presence, even during a bullish move. While price might initially react positively from this gap, the likelihood of a quick failure is significantly higher. On the flip side, if the third candle is yet another strong bullish impulse, it forms what we refer to as a breakaway FVG. These are the types of gaps we want to focus on. Breakaway gaps indicate continued buying strength and often serve as reliable zones of support for the next leg higher. Although price may take longer to revisit these gaps, when it does, they tend to offer high probability trade setups. Tip number 6. Master trading FVGs around liquidity zones. These are the highest probability setups. To trade fair value gaps, FVGs, like a pro, you've got to understand how they behave around liquidity areas, because this is where some of the strongest and cleanest setups can be found. First, keep in mind, price only has one job, to target liquidity. That liquidity is usually found at external levels, like previous swing highs or lows. But to get there, price uses internal liquidity as fuel, and that's often where your FVGs come in. Let's break it down into two scenarios. Upward trend scenario 1, the liquidity run, continuation move. We spot a clear swing high, that's our liquidity target. Price then makes a strong, impulsive bullish move that blasts straight through that swing high. This is called a liquidity run. Price doesn't respect the high, it completely takes it out. That confirms a bullish trend continuation. Checkmark in this case, the FVG that forms within the move that broke the high becomes a high probability bullish entry zone. This is because it's aligned with both the liquidity run and the order flow, making it an S-level fair value gap, extremely strong target. Downward trend scenario 2, the liquidity sweep, reversal setup. Again, we have a swing high acting as the draw on liquidity. But this time, price fails to close above that level, it taps into the liquidity, then reverses. This is known as a liquidity sweep. Buyers weren't strong enough to break through. Crossmark any bullish FVG that forms in this move should now be considered weak. Instead, this signals a likely shift in market structure, and your bias should flip bearish. You'll want to start targeting bearish FVGs to catch the next leg down. Bottom line, always follow the order flow. FVGs formed during a liquidity run are strong continuation zones. But FVGs that form after a liquidity sweep often signal a reversal, and it's your cue to adapt your bias accordingly. Tip number 7. Avoid trading FVGs during consolidation, focus on trend phases for higher accuracy. One of the easiest ways to stay profitable in the markets is by trading only during trending conditions. Trends offer clarity, all you need is a confirmed continuation, and you're good to go. Most traders can recognize a trend reversal using basic market structure. But once price enters consolidation, that clarity fades, and traders often get caught in the chop, taking losses back to back without a clear directional bias. Here's the key: when you're looking for trend confirmation, you want to see a fair value gap, FVG, get respected. From there, if price continues to push in that direction and forms another FVG, it signals strong momentum and offers a solid trend continuation setup. But when you see a bullish FVG fail, many traders immediately flip bearish. That's understandable. However, if the next bearish FVG also fails, that's your red flag. Prohibited, it's no longer a trending market, you're likely in consolidation. So instead of forcing trades during this chop, step back. Wait for price to create and respect two new FVGs in the same direction. That's your confirmation that the market has likely exited the range and entered a new short-term directional phase. Thank you for watching. I hope you found value in today's video. If you did, go ahead and hit that like button to show your support, it really helps us out. And if you're new to the channel, consider subscribing so you don't miss future content. Thanks for watching, and I'll see you in the next episode.